Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Last week, the Reserve Bank of India retained the benchmark policy rate at 6.5%. The last time this rate was raised was in February when it went up from 6.25%. Again, the RBI had paused during the April meeting. For those new to the terminology, the RBI's Monetary Policy Committee meets once in 2 months. But what was different during the June policy statement, the governor's address after the meeting happened, was the focus of the RBI on reining in inflation has significantly sharpened. Before we see how, let's look at some basic factoids. From the chart on your screens, you can see how the 6-member team comprising the Monetary Policy Committee has voted starting May 2022 on both fronts. One is on the rates themselves, whether they need to change and if they need to change by how much. And then on the second front, on policy stance at withdrawal of accommodation. Starting May 2022, the Reserve Bank has raised the benchmark interest rate by 250 basis points. For this fiscal year, that is 2023-24, the RBI pointed out that the demand conditions in the domestic market seemed supportive of growth, given that household consumption as well as investment activity both seem to be picking up. Urban demand, it said, remained resilient with indicators such as passenger vehicle sales, domestic air passenger traffic, and credit cards outstanding posting double-digit expansion on a year-on-year basis in April. Rural demand is also on a revival path, it pointed out, citing motorcycle and three-wheeler sales, which had increased at a robust pace in that month. However, it also pointed out that tractor sales remained subdued. For this fiscal FY 2023-24, the Reserve Bank has retained its estimate for economic growth for India at 6.5%. What it has done, of course, is that it said that the first half ending September would be slightly higher than earlier anticipated, while it has toned down its forecast for the second half. Inflation seems to be a concern for central banks around the world. Bank of Australia, for instance, actually went ahead and raised rates at its policy meeting earlier this month and also warned of further interest rate hikes, citing persistently high inflation. A Reuters report said that the bank removed references to medium-term inflation expectations remain well anchored, which had been part of its statements since July last. The Bank of Canada too raised rates earlier this month, and this time it touched a 22-year high. And like its counterpart in Australia, this central bank too is expected to raise rates again next month. A Reuters report cited analysts as saying that an overheated economy and high inflation were reasons for this rate increase. If inflation indeed runs amok across the world, India cannot hope to remain immune to this trend. That's likely why the RBI had a subtle change in the tone of its statement last week when it talked about inflation. Now the focus seems very clear that the RBI will target inflation at 4%. Earlier, the focus seemed to be bringing inflation below the upper limit of its tolerance band, that is within 6%. For those new to the topic, you may want to know that the RBI had been mandated to retain inflation between 2% and 6%. In his address after the policy meeting last week, RBI Governor Shaktikanta Das said, "Given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4%. In its forecast, the RBI said that it expected full-year inflation for FY 23-24 to be at 5.1%. This is slightly lower than the 5.2% it had estimated in the April meeting. If you look at an ideal scenario, all of us would love low inflation and high growth. But in reality, it's a delicate combination to achieve. In an editorial, a sister publication, Business Line, said that RBI should be mindful of the impact of the continued high interest rates on consumption. Growth in private final consumption expenditure in the fourth quarter, that is the quarter ended FY 23, was a mere 2.8%. While urban demand, it said, had been led by the buoyancy in services sector, rural demand has been slowing. It referred, interestingly, to growth in priority housing loans, which was an anemic 1% in FY 23, while non-priority housing loans grew 23%. This, it said, could hurt borrowers with a lower income profile. Given all of this, one would likely pose a question, so why is the RBI so focused on inflation? Or in industry parlance, why is the RBI so hawkish? This is because, as Professor Lekha Chakraborty of the NIPFP says, the RBI has been mandated to target inflation. So the responsibility for the growth impetus falls on the government that has to use fiscal tools at its disposal. She says fiscal policy has to remain accommodative. Before we wind down this episode, let's look at a couple of other pieces of data that seem to be encouraging for the rupee on the currency exchange markets. One is the trade deficit, the other is foreign portfolio investment inflows. Debt ratings agency CARE Ratings said India's merchandise trade balance has witnessed a notable moderation in recent months after staying elevated for most of FY23. This decline in the trade balance was aided, it said, by lower commodity prices and moderation in imports. The agency said it expected current account deficit to moderate in the final quarter of FY23, gaining support from healthy services exports, remittances, and easing pressure on the merchandise trade balance. Here's how FPI inflows looked in recent months. The chart on your screen shows some heartening green-colored bars starting March. On the investment front, there have been foreign portfolio investment inflows worth 8.6 billion so far in FY24, as against outflows of 5.5 billion in FY23. And remember, we are only in the third month of this fiscal. That's all we have for now in this episode. And if you're watching this on YouTube, do not forget to like, share, and subscribe. Till we meet again, have a lovely week ahead.